Hi, friends. Welcome once again. So, at this point, what we're going to be doing is that we'll still take an alternative approach, okay? An alternative approach to the consolidation process. So, we're going to present similar thoughts, similar ideas, and mechanics, okay? And we work it similar. Format, structure, pro formas are similar. So kindly decide which one works best for you. Okay, they are all professional approaches, and we will accept any of them. In fact, any professional body e- examiners from these professional bodies will always admit these processes. Okay, so let's try again using simple basic steps. Simple basic steps. All right. So I share the screen. I share the screen. Um, in the first instance, I would like us to consider one or two elements of the consolidation. We will touch on almost everything in the first two sections that we've populated. I mean, on the basics, on the mechanics, using the approach from the ACCA text by Kaplan. Our focus here will still be on same stuff. Okay, we'll keep progressing from basic to intermediate. Okay, and we leave it there. To advance, maybe, but I think this FA3 more looks like an intermediate level. It can also be classified as advanced. In some settings, they call it advanced financial reporting, and it's the same thing we are doing here. Okay, so it's nothing complicated. It's advanced, yes, it's technical, but it's very easy. Okay, so we look at group reserves, and then the non-controlling interest sections. We'll still consider some items of goodwill in the discussions. Okay. All right. So we have seen the intangibles from week one, right? And an introduction to it from week one. In this particular week, we are looking at the goodwill, fair value adjustments, okay? Reserves and non-controlling interest. So I'm going to use this one to dwell more on the reserves and the non-controlling interest. All right. So we take a full-blown question to look at the full consolidation process, a fully worked example. Okay, for the sake because we want to make it quite um, simplified, I'll not make this video lengthy. I'll cut it off at this point. I'll cut it off at this point. Then I come back and treat this. Okay, so these will consist of, let's say, part. Should we say part A? Okay, and then we'll say this is part B. Okay, part B. All right. And then we summarize it. Okay, so let's kickstart on the part A. So the full consolidation process, remember the steps. In addition to the basic standard workings, remember the steps. Remove any investment from the parents, share capital from the subsidiary, knock them off. Add assets and liabilities together. Let's look at the impact of fair values adjustments, okay? Then we'll look at the goodwill, the reserves, NCI, and then we'll finish off by adding and subtracting what we are supposed to add and what we are supposed to subtract. Okay. Reserves. Reserves. So the reserves at acquisition of the subsidiary, the reserves of a subsidiary at acquisition is not consolidated. Instead, we try to split them between pre-acquisition reserves or acquisitions or retained earnings at acquisition. Okay. Then we look at the post-acquisition, any retained earnings or reserves after the acquisition period. Okay. So any profits after. So we split them between these two. Okay. Because at the time when we acquired them, what was their retained earnings? What was their reserves? After we've acquired them, what was the extra profit or reserves that they made? Note carefully, the fact that we are looking at profit doesn't mean the company maybe getting profit. Okay, so the post acquisition profit could also be post acquisition losses. And if these are post acquisition losses, of course we need to recognize them. Okay, we need to recognize them. We need to split them. Okay. So the pro forma looks, this is another alternative approach. Okay. So that of the parent, that of the subsidiary, you realize that it syncs to the earlier standard workings that we have looked at. Okay. So for the group reserves, especially for the group's reserves. So the reserves at consolidation date for the parent and that of the subsidiary. Put them together at the consolidation date, at the reporting date, okay? If there's any unrealized profit provisions, let's subtract them. Depending on whether it was the parent which was transferring to the subsidiary or subsidiary which was transferring. In either case, we subtract them. We'll look at the intragroup trading in the next week's session, okay? Either way, subtract the unrealized profits on this intragroup trading. And then again, look at the reserves at acquisition. Only that of the subsidiary, okay? And then look at the fair value adjustment on consolidation, only for that of the subsidiary, and subtract all these. At the end of the day, you get what we call the post-acquisition increase, okay? And then split it. This element represents 100%. Split it between the minority, the NCI, I don't want to use minority. Split it between the NCI, this particular portion will be split between the NCI and then the group, okay? Well, the group's share of Y, assuming it was a full 100% that the parents acquired of the X, then everything here becomes the Y. Everything here goes to the Y. But if we did not acquire 100%, but we acquire, let's say, 80%, then we're going to split this between the parents' portion and then the NCI's portion. Do you realize it is the same as what we did in the earlier scenario? Okay. Then if there's any goodwill impairment, the proportion that belongs to the group, we just assign it. If it is 100% ownership, everything goes to the parent. But if it is split between the NCI, then just the portion for the parent comes here. Okay. Then we knock it off and get the net value, which we transfer to the statement of financial position. We'll take a simple example and you get it. Let's take this. So, for example, the parents acquired 100%, so there is no NCI, okay? NCI is not applicable here of the shares. And they paid on 1st January, okay, 2012, and they paid 1.3 million in cash. Purchase consideration given, very easy in cash. But remember, like we said, it sometimes can be in shares, can be in deferred payment, okay? The share capital of S of the subsidiary then at the date of acquisition was 100. The reserves of the subsidiary at the date of acquisition was 1.2. Now we are given the full account of the parent and the subsidiary at the reporting date, okay? So summarize statement of financial position at 31st December 2014, okay? 31st December 2014, 31st December 2014. For the two of them, okay? All right. So the property, and we know at this point, it makes life easy. We know that we'll always add this up, right? Investment in S. And then current assets, we know it is easy. We always add it up, assuming there are nothing to adjust, okay? At least for a start, on the face of it. Share capital, we know that we'll only be interested in this one. The reserves, we'll be interested in this, but these we need to consider the pre-acquisition portion and the post-acquisition portion. And then for the liabilities, we add both, okay, for now. But we all know, okay, so remember they said we acquired it at 1.3. And since it is 100%, we've made life easy that the 1.3 is the same over here. The investment in S is the same, okay. What is the first step over here? Cancel out the investment against the shares of the share equity. If there are any other components of equity, consider that one as well and knock them off, okay? So we knock this 300 against the 100. You ask yourself, why would it balance? Don't worry about balancing now. Understand what it works. Forget about the balancing. So this 13 knocks off this 100, the share equity, against the investment, the share capital of the subsidiary, against the investment that was made by the parent must be knocked off at the first instance to make life easy. The others we know will add them up, assuming there are not much to be done. Okay, all right. Now we move on to the next step. The next step, like I said, we add our property, plant, and equipment. Current assets, we add them up. Nothing much. The question is quite straightforward. For the share capital, if you realize, I just said we will be taking only that of the parent company. Okay, so for the share capital, that of the parent suffices. The reserves, we have left this hanging for now because we need to adjust it, look at the pre-acquisition, the post-acquisition, and then we find out what to do about that. Okay, the liabilities, add them up, makes life easy. So the ones you can easily get them in terms of addition and summing them up, adjusting them, do it very easily, straightforward. Okay, then we move on. Remember, in the question there was no fair value. We are not saying the carrying amount of a PPE is less than the fair value on the market. We're not saying that. We left everything very basic and easy for now. Okay. Now, we calculate our goodwill. How much did we pay? The cash consideration, the fair value of the consideration paid. 1.3 million, right? Remember, everything here is held in thousands. Okay. 1.3. We then add the non-controlling interest at acquisition. Is there any non-controlling interest here? No, it's 100% fully acquired. So there's no need for us to add. If otherwise, we would have added this. Okay, but for now there is nothing, so it is nil because it's 100% acquisition. It's rare. Okay, just a simple example. Now we look at the share capital, equity capital of the subsidiary, the 100 that we knocked off. Okay, we subtract it, and then we also subtract the acquisition, the retained profit at acquisition of the subsidiary. Okay, and when you look at the question, we said when the parent acquired it, the reserves of the subsidiary was 1.2. Okay, so these two elements we combine, we would then consider them to be what? The identifiable, okay, identifiable net assets of the subsidiary. Okay, fair value, of course, it should be measured at fair value. Okay, but look at it. Was there any adjustment? Fair value adjustment? No, there was no fair value. This is a simple, straightforward, okay, item over there. So subtract the fair value of the identifiable net assets from the purchase consideration, and coincidentally, we make a zero goodwill. Okay, that's it. 1,300 against 1,300. This is rare, but this is a simple illustration for us to be able to understand. Okay, so if there's any goodwill impairment, if there's no goodwill, how would you even impair it? Okay, all right. Then we move on. Let's finish this one up. Okay, easily we add our property, plant, and equipment, non-current assets. The current assets, we add them up. Goodwill was zero from what we did from our calculation. Share capital, we only take that of the parent. Okay, liabilities, we add them up. Look at it carefully. When you go into the question, you will see that the reserves of the subsidiary was 4,200. But at the date when we acquired the company, the reserves was 1,200. It means there has been some element of post-acquisition profits. 1.2, and now at the reporting date is 5.2. Where from the extra? The extra accounts for what? Okay, so that's the next thing we will be looking at. So you realize that we've intentionally left the reserves hanging once again. It means we need to work on this one. Okay, so for the group reserves, first, consider everything of the parent, 26,800. If you go to the question, you realize that we are picking everything from the parent. Okay, what is the reserve? 26,800, and we are picking everything of the subsidiary as well, 4,200. After which we then adjust for any pre-acquisition profits or any pre-acquisition retained earnings. Okay, so this for the parent, 100% of it, the subsidiary, 100% of it. Now realize that at acquisition, the retained earnings of the subsidiary was 1,200. Was there any fair value adjustment? No. This is a very basic question. Okay, therefore it tells you that there is an excess of 4 million actually for as a post-acquisition reserve. This represents 100% of the reserves for the subsidiary post, and we must split it between the NCI and then the parent. But in this scenario, there's no NCI. Parent acquired 100%, so parent would take all the 100%. Otherwise, the parent would take its portion, and then NCI will also take its portion. Therefore, after this, we add it to the parent component and we get a reserve total of 3,800. 3,800. We can now finish up our calculation. Okay, we can now finish up our calculation. We can add up our non-current assets, the current assets. Goodwill we determine to be nil from our calculation. Share capital, that of the parent only. The reserves which we have worked, group reserves consolidated is 3,800. And then when you add the liabilities, our figure must balance off easily. There's no NCI. We'll look at NCI, okay? We should balance off easily. So work it, and you realize that we get 38,800 and 38,800 balancing off. This is also an alternative approach you could use. Very easy to understand, quite logical, makes a lot of sense, okay? Now, I said I'll cut it off at the NCI, or the non-controlling interest. So let's look at the non-controlling interest, okay? Let's look at the non-controlling interest, and then we proceed from there. So I'm going to end here, quite straightforward for the first segment, and then we'll look at the second portion where we deal with the non-controlling interest, okay? So we'll end here. We'll end here for the first segment. So look at that approach also, quite easy, very sequential. Look at the group reserve, how we adjust that of the subsidiary, and then we bring it, we split them to whether there's an SCI component and then the parent component. In this scenario, it was one single entity who acquired everything, no NCI, so it makes life easy, okay? We take this approach as well. All right, I'll see you in the next session, the part B. Bye for now.